The plain fact is, if you look at the macroeconomic environment right now, it is a negative environment for gold. And so the ordinary investor perhaps sees that. And what's been driving gold in particular, of course, are things, central bank buying because of dollar weaponization, Chinese investors buying because they're worried about the banking system. Well, these people are not worried about the macroeconomic environment. That's not why they're buying gold in the first place. So it's not illogical that gold is moving up to new highs and we're still not seeing a flood of people pouring into gold stocks.
The past few weeks have seen an incredible surge in gold prices, setting the path for record-high closings above $2,400. This unexpected rise has largely been triggered by the market's anticipation of the Federal Reserve cutting down rates soon. Central banks in markets such as China, India, and Russia are tending to increase gold reserves to avoid being too dependent on the USD. In addition, Turkey has a large gold hoard in the context of hyperinflation, and Poland is also the central bank's net gold buyer. Adrian Day of Adrian Day Asset Management said that while things aren't quite as strong as they appear, and we might anticipate them worsening, the plain fact is that the current macroeconomic environment is negative for gold. The sentiment in the West is still pretty negative, he added. Gold fell more than 2% on Thursday after a better-than-expected reading on U.S. gross domestic product fed the potential for higher-for-longer U.S. interest rates, which contributed to a drop in the price of the precious metal to the lowest level in more than 2 weeks. Considering the holding rate of countries in gold reserves worldwide, the U.S. holds the most, with more than 8,100 tons, equivalent to 22.85% of gold reserves worldwide. The next is Germany, with a 9.41 holding rate. China, which has been continuously increasing its reserves recently, is holding only 6.36%. Recently, when China reduced its purchasing of gold, India still maintained a purchasing power of 4 to 6 tons per month. At the same time, the Central Bank of India also has the motivation to reduce its dependence on the USD by directly joining the BRICS bloc, a counterweight to the US and European countries. Adrian mentioned that the factors driving gold recently include central bank buying due to dollar weaponization and Chinese investors purchasing gold out of concern for the banking system. These buyers are not influenced by the macroeconomic environment, which is not the primary reason for their gold purchases. I don't think the gold price is pricing in rate cuts at the moment because central banks and Chinese buyers, who are the primary buyers, don't care about the Fed's rate cuts, he noted. Before we dive into more content, consider subscribing to the channel and enabling notifications to stay updated with our latest uploads.
If you look at the macroeconomic environment and look at the things that drives gold, lower interest rates or negative real interest rates and higher inflation and weaker dollar and softer economy, meaning the Fed's going to start cutting rates and a weak stock market. Well, that's not the environment we're in right now. You and I, or I'll speak for myself, I may say things aren't quite as strong as they appear, and we may look ahead and say they're going to get worse. But the plain fact is, if you look at the macroeconomic environment right now, it is a negative environment for gold. And so the ordinary investor perhaps sees that. And what's been driving gold in particular, of course, are things, central bank buying because of dollar weaponization, Chinese investors buying because they're worried about the banking system. Well, these people are not worried about the macroeconomic environment. That's not why they're buying gold in the first place. So it's not illogical that gold is moving up to new highs and we're still not seeing a flood of people pouring into gold stocks. Well, the sentiment in the West is still pretty negative, right? You look at the coin dealers, you look at deliveries from the mint are lower. You look at premiums on coins, they're lower. These are reflections not of a strong market, but of weak demand. Then you look at GDX and the other gold ETFs. The gold ETFs in North America and Europe are still seeing net outflows. So you look at a GDX for the last 3 months, and my gosh, we've only had about 8 days where there have been net inflows. It's astonishing in the last 3 months, even though gold has moved up. And the same goes, which is even perhaps more surprising to me, with the gold stocks. You look at, did I say GDX? I meant GLD. Sorry.
No, you said GDX, yes, but you meant GLD.
I
right?
meant
Yeah.
GLD, the physical gold. Now we'll switch to the gold stock ETFs, of which the GDX is the largest. And in the last 3 months, it's been $1.3 billion of outflows. $1.3 billion of outflows. If you look at the, Van Eck reports the inflows and outflows on a daily basis. Some days there is nothing reported because it was too small, and it just stays in cash. But the days when they actually invested or had to sell, there's only been about 7 days in the last 3 months where there have been net inflows. It's astonishing. And the net inflows have been, by and large, pretty small compared with the net outflows. Now, we manage a gold mutual fund, as you know, for Peter Schiff, the Euro Pacific. I'm not allowed to talk specifically about our fund, but let me just say that when I talk to other gold mutual fund managers, everyone, so you can infer what's happening to us, everyone is seeing outflows. It's astonishing. Now, these outflows may not be dramatic, but they're steady outflows. And the ordinary investor in the U.S., I think there's a lot of things going on, but we can say the ordinary investor in the U.S. is not a believer that the market has turned yet. I don't think the gold prices, I may be wrong, but I don't think the gold price is pricing in rate cuts at the moment. Again, because look who's buying. It's central banks who are buying. They don't care what the Fed does about rate cuts. It's Chinese buyers. They don't even know what the Fed does about rate cuts. There's also clearly some additional buying when you add up the numbers. You look at the central bank buying, which is reported, the Chinese buying, where you have very good numbers from the Shanghai Exchange and from Hong Kong imports into China. And you have Chinese gold production, of course, which all goes to the central bank. But in terms of a consumer in China, it's the Shanghai Exchange and it's Hong Kong imports. You look at those numbers and then you look at the ETFs and you look at the outflows from the ETFs. There's a missing component, right? There's a missing component. And the missing component, I think, are a few discerning, intelligent, but wealthy, a few wealthy individuals and families in the Middle East, in Asia, and also in North America, but a few wealthy individuals who are buying gold over the counter. So the individual trades are not getting reported, right, in a way that individual central bank purchases and sales are being reported. They're not being reported, but this is OTC, over-the-counter buying of gold, and that's what's driving gold. And I don't think those people are buying because of Federal Reserve interest rate cuts. I think they're buying because they're worried about the fragility of the system, frankly.
The U.S. dollar index, which measures the value of the U.S. dollar against 6 other major currencies, retraces its recent gains ahead of the release of the U.S. Personal Consumption Expenditures Price Index for June. Stronger U.S. economic data have reduced some rate cut expectations for September, which might provide support for the greenback. All precious metals, including gold, see sharp declines. Adrian Day thinks that any of these scenarios are overwhelmingly likely in the next 6 months. When the macroeconomic environment starts to shift, ordinary investors and small institutions will turn towards gold. He thinks that when companies start to report their second quarter earnings later this month, we will see some very attractive cash flow numbers, better than those of the first quarter and the year-ago comparisons. Now, let's turn our attention back to the video.
The macroeconomic environment, all of the factors that normally drive gold, are actually negative right now. That's a positive. If you're a contrarian, because it only means, the Fed has to cut rates, or inflation has to go back up, or the dollar has to fall, or the economy has to slow, or the stock market doesn't have to collapse, but it has to roll over. Are any of those things possible in the next 6 months? I would say absolutely overwhelmingly, yes. So when the macroeconomic environment starts to shift, investors will turn, ordinary investors and small institutions will turn towards gold. And with regard to the gold stocks, again, you only need, remember, you mentioned the stocks are continuing to grow. The S&P this year Well, the S&P and Nasdaq are the two best performing major markets this year. In the last quarter, Hong Kong outperformed, but on a recovery bounce. So these markets are continuing to go up, but everybody knows. I mean, I think it's well publicized, and NVIDIA represents half of the gain. One stock represents half of the gain. Let's just think about that for a second. And then you look at this, we've got an all-time high in the market, but we've got more individual stocks hitting 52-week lows and 52-week highs. The breadth in this market is astonishingly bad. And when you see that, that is typically the precursor of a market that's going to fall. I read something, and I'm not 100% sure, so I won't say it, and I apologize for not attributing it to somebody else. But he looked at all the different indicators of the market, and his conclusion was, I am not stating that the market is going to go down a lot in the near term, but this is what a market peak looks like. If this is this is what a market peak looks like. And I think we're at that point. You look at the gold stocks, they are selling at very close to multi-decade lows in valuations, which is just nonsense. You look at Agnico Eagle, which is the third largest gold mining company in the world, and there's no particular hairs on it, meaning there's no particular reason anyone can point at Agnico and say, oh, well, that's why that's cheap, because they're in Pakistan or something. And yet it's selling at about 2%, within 2% of its lowest price to cash flow. It's in its entire history. Now, with gold at record highs, does that make logical sense? Can it last? One of the things that's going to change it, I think, is you look at the quarter that's just finished, the second quarter, and the gold price was $250 an ounce higher on average than the average selling price in the first quarter. We forget that gold only really moved up in March, right? So the average selling price for the first quarter was $2,070. For the second quarter, it's $250 higher than that, and yet the costs will be more or less the same. The oil price just $1 or $2 higher on average. Commodity currencies, Australia dollar, Canadian dollars, South African rand, more or less the same. So the margins, what I'm saying is the margins, meaning the cash flow, should be very, very strong when these companies start reporting. I have to think, partly because I'm a rational person, partly because I'm an optimist, but I have to think if you have two back-to-back quarters of strong cash flow for gold stocks, someone, somewhere is going to notice.
Given the United States' pivotal role in the global economy, coupled with the prevailing geopolitical uncertainties, the upcoming presidential election is viewed by many as a watershed moment with far-reaching implications. Gold did well during both Trump and, so far, Biden presidencies through a combination of policy decisions and broader global macroeconomic drivers. Gold rose by 60% during Trump's presidency, increasing by nearly 30% pre-COVID and slightly over 30% during the pandemic. Under Biden, gold moved sideways initially but has gained more than 30% during the term so far, primarily due to broader macro factors and central bank buying. What's next for gold? We want to hear from you. Leave your thoughts in the comments. Give us a thumbs up if you liked the video, and subscribe to stay connected with our ongoing exploration.